Well, you know, the message the RBNZ sent this week was cautious moves, 25 basis point rate hikes in the official cash rate, that is, up to expected 2% by the end of 2022. How did you select 2%? Why that number?
Well, our central projections have the official cash rate getting up a little bit over 2.5% over the end of our projection period. And for us, it's really a story about, you know, where we think we need to be setting policy to achieve our policy mandate. And the reality is that in New Zealand, we've had a very resilient economy. We've got core inflation running near the top of our 1 to 3% target range. We've got an employment market that's through what we think is maximum sustainable employment. So we're getting pretty clear signals that we need to start or continue this process of removing stimulus and getting interest rates back up towards neutral.
So how will you know if you're moving too quickly and jeopardizing jobs growth, or moving too slowly and risking letting inflation become more persistent and get out of control? What are you going to be watching?
It's a great question, and it's the balancing act that I think all central banks have to go through in setting policy. We really look at what are the balance of risks to the outlook, and at the moment we see them pretty finely balanced. On the upside, I think that the risks are that we've had a very strong economy, a big change in the starting point, inflation expectations. There's a risk that they sort of lift, and we can certainly see that happening in the near term. But on the other side, we've got interest rates have actually moved a long way here in New Zealand. Mortgage rates are nearly 2% up from their lows in January. And ahead of us, we're going to have to be navigating having COVID in our community, which is a very different strategy than we've experienced over the last 18 months or so. So we see things pretty evenly balanced, and that's really what pointed us towards taking considered steps for now.
Well, what would tell you that you have to be more aggressive, that the balance of risk has shifted? And at the press conference with Governor Orr, with you and the rest of the team, it was pretty clear that there is a concern that could happen, that the balance of risk could shift.
Yeah, that's right. And we do have the benefit that we meet again, and we can consider our decision again and see where we want to take the official cash rate from here. In terms of the upside risks, I think it really does come back to inflation and inflation pressures here domestically. We have a very tight labour market at the moment. We have core inflation sort of getting up towards the top end of our target range. So inflation expectations are going to be absolutely key for us. At the moment, they're doing what we would expect. 5 to 10 year inflation expectations very well anchored at the midpoint of our target. Short-term inflation expectations have lifted with headline, but lifted in a way that we would anticipate. So I think that's a really key thing, to watch forward, how that develops through time.
Mr. Hawkesby, as a fellow Kiwi, I well remember the days in the early 90s in New Zealand where inflation ran extremely hot. Are you at all concerned that you could get into that kind of situation, and do you have the tools to stop it from happening?
Yeah, well, we are in a different environment. You're right. Over the last 10 years or so, the challenge for central banks around the world has been trying to lift inflation from below to get back to the midpoints of our target. And it's felt like quite a foreign environment to be in over the last 10 years, facing that challenge. I think now in the period ahead of us, and New Zealand's probably at the forefront of this, is ensuring that inflation comes back to the midpoint of our target from above, with inflation running above the midpoint. We think we've got the tools that we need. The challenge when inflation is very low is that you end up having to use all these other alternative tools as room runs out on interest rates. Now we're back to using our traditional official cash rate, and we can keep lifting that as far as we need to get confidence that we do have things under control.
Mr. Hawkesby, it's Yvonne in Hong Kong. again, you hear some central banks as well talking about that, inflation is just transitory, right? That we might see the supply chain bottlenecks ease a little bit, maybe early next year, that perhaps there isn't a need to kind of front load these rate hikes. What do you say to that? And what makes you so convinced that inflation is not transitory?
Well, we see you really got to look at the different elements of inflation and where the inflation's coming through in the economy. Certainly there are a lot of one-off effects happening at the moment. We know that there are particularly the supply side disruptions, the supply chain disruptions that are causing these, shifts in price levels. These are proving more sort of prolonged than we had originally anticipated, but we do see those dissipating through time. So our inflation forecast domestically is for inflation to lift from a little under 5% at the moment to a little under 6%, and then come back down through the course of the second half of next year. And that is partly some of these transitory factors are working their way out. That's a similar story to what global central banks are talking about. But we also see domestic inflation pressures building as well, and we see that in our non-tradables inflation here locally. And it's really those persistent domestic inflation pressures that we really feel we need to lean against. And we're in a little different position from the rest of the world because we started COVID in a different starting point. We had a strong economy going into COVID, and we were sort of moving out of COVID into this endemic COVID world with a strong economy as well.
Looking again at some of the global forces here, the Federal Reserve has made it very clear they're starting their taper. Now the signals are that they may be in favor of speeding up the taper. On that realization, as that's kind of sunk in to investors, we've seen the dollar strengthen, possibly one of the reasons why the Kiwi has weakened recently. U.S. bond yields are rising. So as that continues, a more hawkish Fed, maybe they speed up their rate hikes. Could that impact your exchange rate? Could it impact bond yields? Could it influence the policy steps that you do or don't take?
Absolutely, and that's the environment that we need to navigate each time we get together again to make our decisions about interest rates. Absolutely, we're a small open economy. The global environment affects us through a number of channels, whether it's the trade channel, the financial channel, or the sort of uncertainty confidence channel. Whatever the Fed does will influence global yields, global interest rates, the liquidity of global markets, and so you could possibly see our monetary conditions tightening through those channels. Equally, there will be impacts on the exchange rate as well. So we'll just need to feed those through each time we get together and just do what's right for the New Zealand economy with a laser focus on what our mandate is and what we're seeking to achieve.
You said that at the meeting, in fact, that you're going to be looking at your plan to manage down the emergency bond purchases. You're going to start working on that after the first of the year. At this point, do you have any sense of the optimal size of your bond holdings as you get through that process? And again, how significant of a part of your policy position, your policy strategy is this?
Yeah, so we haven't got to the point of devising the optimal balance sheet size. That'll be something that we work through, but we do know that we need to start gradually reducing the size of our balance sheet from where it is. We halted our large-scale asset purchase program back in July, so we've completed that taper process and have our balance sheet constant at the moment. We are looking to gradually reduce the size, and that's just really part of this sort of broad process of removing stimulus. We'll do it in a way that supports the smooth functioning of markets, and that the practical decisions for us are really about reinvestment of maturing bonds and then eventually questions around whether we sell down assets. The key thing for us, though, is that we want the main focus to be on what we're doing with the official cash rate, because we think that what's going to have the biggest impact on monetary conditions for New Zealand.
I want to come back to the question of inflation expectations and how you expect rate hikes to go over the course of this year and next. If inflation expectations keep rising, it seems to me that in announcing this recent rate hike, you put a lot of emphasis on that. If inflation expectations rising, if that persists, is that something that could cause you to hike rates more aggressively this year to speed up the process?
It's absolutely one of the risks that we see there when we look at what's ahead of us, what would make us go faster, what would make us go slower. And we've said very clearly that we're in a position where we feel like we can take considered steps for now, and that's been consistent with the 25 basis point moves we've made in October and now in November. There are things out there that could make us slow down and pause for a while, particularly if the impact on the tightening and monetary conditions impacts the economy more quickly than we expect. There are things that could make us go faster, and I think the inflation expectations is one channel by which we may feel like we need to go faster, and that's why we've left ourselves that optionality that we take considered steps for now, but we revisit that in the future.